We're diving right into a high-energy analysis report on RCAT Holdings, RCAT. It asks a big question. Is the pullback over?
And it makes a really strong case that the defense at $9 plus this huge FCC drone ban catalyst means a breakout is pretty much imminent.
Exactly. So let's get straight into how we can maximize the impact of this very aggressive thesis.
The conviction in this piece is great, really excellent. And that focus on the $9 level as the spot, the entry point, it perfectly matches the high-stakes style they're going for.
Right.
But, to really elevate this, to make it that opening bell report level of analysis, we have to fuse the chart dynamics and these regulatory fundamentals with just laser precision.
Okay, so a key theme here is obviously the defense of that $9 mark. The analysis report really hammers that home as a critical floor, both technically and psychologically.
It does, and that brings us right to our first big opportunity for refinement.
The core strength of the report rests on the connection between the immediate technical defense and the long-term blue UAS supercycle, but the transition between these two powerful concepts requires strengthening.
That's it. Right now, the material presents the technical analysis, the $9 level, the 85 floor, the fight near the 50-day moving average.
And then, later on, it presents the fundamental catalyst, the 646% year-over-year revenue growth, the NDAA ban.
Exactly. It's almost like two different reports that were stapled together. You have the what, and then pages later, you get the why.
And that structure, it just limits the immediate emotional impact. You're basically forcing the trader to connect the dots themselves. Why is smart money defending $9? The report should be screaming that reason from the get-go.
We need to pull those elements together. My suggestion is to resequence it, or better yet, integrate the fundamental catalyst much earlier, right into the technical section.
So you explicitly link the market's defense of $9 to the fact that institutions know this massive demand vacuum is about to open up for RCAT.
That's the move.
I agree that linking them is stronger, but let me push back on that a bit. If this NDAA mandate is so massive, it's a government-mandated removal of competitors. Why is the technical defense line only at $9? Shouldn't it be higher? We need to justify why that specific level is the line in the sand.
That's a fantastic question, and that's where the story gets really compelling. The $9 level then becomes less about some arbitrary support line and more about strategic accumulation.
Okay.
So if the report introduces the blue UAS opportunity right after establishing that $9 defense, it answers your question directly. You could phrase it rhetorically. Why are they defending $9 so hard? Because the smart money just woke up to the fact that the NDAA has eliminated RCA's largest competition, creating this undeniable vacuum in demand.
That totally reframes it. The chart pattern isn't just a pattern anymore. It's the footprint of institutional capital building a base because they know what's coming. It's informed defense.
Informed defense. And let's not forget the financial position, which is just as critical here. The analysis report mentions the $212 million cash fortress.
Right, but it's mentioned later.
It needs to be way earlier. You use that detail to reinforce the technical strength. You frame the defense of $9 not just as a pattern on a chart, but as a position backed by massive resources.
We should be careful, though. In this sector, a huge pile of cash can also be a sign of slow deployment, not just readiness. So how do we frame that $212 million as deployable capital for scaling up?
Well, you have to emphasize that the company has the liquidity to scale immediately, to capitalize on this ban. They've got the cash. They don't have to wait around for debt or dilute shares to ramp up production for this sudden government-mandated demand.
So that financial firepower is a core reason why the $9 defense should hold. It's why institutions would pick this moment to get in.
Precisely. It confirms the thesis. They can actually absorb the demand created by the ban.
Okay, that seamless integration gives the entire analysis report a much tighter, more powerful foundation. So, moving on, let's look at the core contrarian narrative, this whole bear trap idea. The report does a good job flagging that fake-out dip to 885 and the quick recovery. It's a key part of the story.
It's clearly laid out, yeah. But we need to maximize the precision of that contrarian narrative. It has to be anchored to the specifics of the fundamental shift, not just, market games.
To fully capitalize on the contrarian bear trap narrative and align with the high conviction style, the analysis report can make the urgency and timing of the price movement more precise and less generalized.
Exactly. Right now, the narrative uses these broad concepts like Wall Street tried to flush retail traders out, or they want your shares cheap. It's high energy, sure.
But
But it misses a huge opportunity to connect that technical action, that dip to 85, directly to a specific systemic inefficiency related to the catalyst. It feels a bit like a conspiracy theory instead of a market insight.
I appreciate moving past the generic bear trap, but how do we prove this dip was about market lag? The slowness in pricing in the FCC ban, and not just typical technical selling pressure that was probably going to happen after a run-up anyway.
We anchor it. We anchor the fake out specifically to the market's reaction lag regarding the legal implementation of the ban. Think about it. When major legislation like this passes, it can take institutional trading desks weeks, sometimes months, to update their models, rotate capital out of the now non-compliant rivals, and get the green light to pile into compliant firms like RCAT.
So that gap, the moment the news is legally binding, but before the big money has finished its rotation, that's the inefficiency.
That's the golden window.
So the 885 dip wasn't just random selling, it was the final moment of low liquidity before the required capital really started to flow in.
Precisely. You reframe the fake-out hook to focus on that time delay, between the December 23rd FCC news and today's price. You suggest the dip is a function of the market's initial failure to grasp the legal finality of the ban and the huge capital rotation that it requires.
That's a much more specific, insightful reason for the defense than just manipulation. It's sophisticated price discovery finally catching up to a fundamental reality.
And it's a much more robust and defensible position. It gives the argument real intellectual grounding beyond just reading squiggles on a chart.
So building on that, let's talk about the high short interest.
Yes. The report correctly flags that 16.5% short interest as future fuel. But we can use that metric for so much more. It's not just future fuel. It's immediate proof of the very market mispricing we were just talking about.
So the shorts who piled in were betting that either the ban wouldn't actually stick or maybe that RCAT couldn't scale up fast enough to meet the demand.
Exactly. And now the technical defense at $9 is signaling that those assumptions are collapsing in real time.
So you suggest that the $9 defense is the critical turning point, where those shorts are about to face the music, the reality of the shift caused by the drone ban and the company's financial readiness.
Yes. The sheer volume of shorts is the active evidence of the market inefficiency the analysis is capitalizing on. The technical defense at $9 is literally squeezing that skepticism out of the system.
That sharpens the contrarian narrative considerably, which brings us to our final point. And this one's about completeness and trust. The overall tone is perfectly high conviction. It needs to be for this kind of report.
However, it's incredibly bullish, and it's backed by hard numbers. That's 646% revenue growth. The strategic blue UAS positioning, the bullish case is strong.
However, for a sophisticated trading analysis, the only hard acknowledgement of risk is the stop loss at 850. And that's it.
Just a number.
Yeah. Which makes the whole thesis feel a little less robust. The exit strategy seems arbitrary instead of being driven by the fundamentals.
And that's the area we need to address. While the high-energy style successfully builds conviction, a brief, clear articulation of the central risk, beyond just listing a stop loss, can paradoxically strengthen the overall persuasive power of the whole piece.
We need to define what fundamental or technical failure would actually trigger that 850 breakdown. What would going wrong look like?
You have to identify the single, most critical assumption the bullish thesis rests on. Then you state what failure in that area would mean. Doing that demonstrates robust foresight, and it shows confidence in your primary analysis.
Okay, so if the stock drops below 850, what fundamental assumption is breaking? The whole thesis is built on RCAT successfully absorbing this massive, sudden demand vacuum.
Precisely. That is the core assumption. So we have to define the failure condition. The entire bullish thesis relies on RCAT using its $212 million cash fortress and its technical capability to rapidly scale and service the demand from the NDAA mandate.
I agree, that's the central pillar, but what specific scenarios could break that scaling assumption? What if the cash fortress isn't enough to overcome, say, supply chain bottlenecks?
Right. We should focus on that lack of velocity. The breakdown condition could be explicitly tied to that. Something like, if the 850 floor breaks, the bullish thesis is invalidated. This would signal the market believes there is a critical failure in RCACT's ability to immediately scale production. Maybe unforeseen supply chain issues or a regulatory hurdle, despite the massive cash position. Or, even worse, that a new, competitive domestic threat has emerged way faster and more effectively than anyone anticipated.
That completely transforms the 850 stop loss. It's no longer just a technical line on a chart. It becomes the definitive litmus test for the entire Blue UAS thesis. It gives the exit strategy real intellectual grounding.
And to make it really actionable, you integrate this defined risk right into the final trade plan section. You state it clearly. We know the stop is 850. This isn't just a technical marker. It's the point where the market is signaling Dell that RCAT can capitalize on the Blue UAS mandate.
And by defining that risk so clearly, it actually maximizes your conviction when the stock is above $9 because you've identified and accounted for the primary threat.
Yes. By clarifying what would break the thesis, that failure to rapidly scale, you're showing confidence in all the existing data, the dash, the mandate, the revenue growth. It's a very smart way to handle risk without killing the high conviction tone. It makes the whole analysis report feel comprehensive.